Hello and happy Panic Monday. No, don't panic. Everything's fine. Actually, markets had a difficult sell-off today, as many of you may know, but it was fairly orderly too. It didn't have the same characteristics of a massive panic that you might typically run into. Importantly, we as a group are not fully participating in today's sell-off, nor have we been over the past few days worth of volatility. You might remember on Saturday I sent out an email with a quick update that just talked a little bit about some of the downside targets we were anticipating. I talked about 9,300 on the NASDAQ, about 3% below where it closed on Friday. We certainly touched that today. And we went a little bit farther than I thought we would on the S&P and the Dow. And while I didn't anticipate it all to come in one day, it does sometimes happen. So I just want to spend a few minutes giving you a couple of perspectives from where we currently sit, what we anticipate to have happen over the next several days, and then what we're doing about it. So as I mentioned, we're not fully participating in this particular bout of volatility. Our most conservative accounts right now, today, Monday the 24th, we're off a little less than 1%. Even our most aggressive accounts were down just a little bit more than 1.5%. So when you have a 3+% down day on a market, NASDAQ, Dow, S&P, whatever it might be, anytime we can utilize risk management techniques to minimize that is good. So we're going to be looking for a few things as we move forward, and we just want to have our minds open for a wide set of outcomes. And what I mean by that is that the current setup that's happening in the market right now has happened a couple of other times within the last couple years. One turned out to be a very, very difficult, very uncomfortable, and very, very damaging time. That was the bear market of 2018. And the other one was the August-September timeframe of just last year, 2019, that turned out to be okay. And there's a glaring difference between the two, but they both started out and set up fairly similarly to what we're experiencing right now. So let me just quickly share with you my screens and give you some technical perspective on the setup and what we're seeing right now. So this is the S&P 500. You can see that on Friday, which is right here, we came down to and pretty much closed right at this level of what we felt was reasonable support for this near term. I didn't like the fact that it was breaking through that trend, but that was okay since we had a breakthrough before and it came down to the 50-day average. So nevertheless, my comment on Saturday's email was that it just wouldn't surprise me to see it come down a couple of percentage points, which I anticipated to hold right around this 50-day moving average, this red line. It didn't do that. It dropped all the way to this level of support here at roughly 32.14 for the S&P 500. And it was a 3.1% negative day. In other words, the market dropped over 3%. That doesn't happen that many times within a market cycle. 3% drops happen, but they're not very common. They average about 1.5 times a year, going all the way back into 1950. So not huge, but nevertheless, we got one today, and the setup that I'm talking about that is fairly similar to what we've seen two other times in the past, one turned out to be terrible, one turned out to be really good, are these downside days. A downside day just simply means that the down volume, the volume in those stocks that are dropping, is dwarfing the volume of those stocks that are going up. And today was 93% downside volume. In the last roughly 21 trading days, we have had 4 of these downside days. The question becomes, what are we going to have over the next several days? Our hope is that we get 2 back-to-back days of 80% upside volume or one day with 90% upside volume. And that could very easily happen because we have to remember the wild card in all this is the Fed. Will they jump in and arrest a market's drop as they've done so many times in the past by juicing the market with additional liquidity and just the support language that they have in so many cases? We don't know. What I do anticipate to have happen is the possibility of a fairly slow grind to close this gap area here. It's a pretty big gap. Most of the time those don't stay open. But what does have a tendency to happen is that when you get a panic low like this, it has a tendency to be tested about 3 or 4 days after it occurred. So that would be later this week. I wouldn't be surprised to see some weakness rolling into the market again, and the expectation and hope is that this level holds. We'll see during that time of a market moving to the upside as to whether or not it holds or whether or not it starts to fall apart. A market that looks like it would hold would be like what we saw just this last year in 2019. I apologize for the busyness of the chart, but there's a lot of detail in here that helps with the perspective of what we're dealing with. The last time we had 4 downside days in a fairly close cluster, roughly a 15-day trading period, was from August the 5th to August the 23rd. We had 4 downside days of anywhere from 83% to 95% on August the 14th. So, interestingly enough, you get a downside day like what you had on August the 5th, another one on the 12th. You get these instances where these markets test these lows to try and see if whether or not they're good. Well, the difference between what we're currently dealing with isn't that we just don't know if it'll work out this way, but the one possibility is that we get these 2 back-to-back upside days, which we had August 28th and 29th, which were each above 80%, and it washed out the negative. And then, of course, markets went on to a fairly significant advance over the ensuing several months. That may happen again. This may have washed out a number and a bunch of the speculative excesses that have come in. And there's been a lot of speculation and a lot of excess coming in. A lot of new retail investors piling into speculative calls, piling into speculative individual stocks, piling into companies that are barely making a profit or only made a profit once, Tesla as an example, in hopes that they're the next new Apple or something like that. But the other potential outcome is, of course, the one that was really bad, which goes all the way back into October, November, December of 2018. And you can see back then the market was operating through this period of support right here from August into September, right? See how it bounced and then boom, fell through. And it was this day the S&P 500 dropped 3.29%, and it was a 91% downside day. It had another one roughly 4 trading days later on the 15th of October, and that too was a bad day. And what's interesting is that the market never had any strength on the upside. Whenever it had an upside day, the volume just wasn't that strong. We never had an instance where, like this last August, we had 2 back-to-back days of 80% upside move. And because of that, this whole market just really, as we remember, fell apart down into the 200-week moving average and then took off from there. So we're tightening up much of our risk management measures, as we have said in the past we are doing. Ever since this 2018 bout of negativity occurred, we've made major adjustments to our algorithms. We've made major adjustments to risk management strategies that we're utilizing. And because of that, what's happening right now and the current lack of participation in this downside volatility are proving the risk management measures to be accurate. But nevertheless, what we don't want to have happen is this. And so we had a cluster of 6 downside days with no positive, strong upside day moves, and that resulted in a terrible consequence for markets back then. Will that happen now? We don't know. As I said, it's a little too early to tell. However, I do anticipate to see this level tested. It usually happens 3 to 4 days after a panic low like what has been set in today. Wild card, of course, is the Fed. If they come in and juice markets, we could see a very strong move to the upside, which may or may not be short-lived. Many are thinking that the economy is slowing, not only here in the U.S., but globally. I don't fully agree with that perspective yet. The leading economic indicators continue to curl up, which prove, at least in the near term, that things appear to be in a growth phase, economically speaking. But we can't ignore the fact that this whole coronavirus scenario could have a negative impact to the supply chain throughout the world, much less China. So day by day is how we take it, piece by piece, data driven. We'll move based on what the markets are telling us on a day-by-day basis, with always keeping an open mind for a wide range of outcomes. Right now, as I said, we anticipate this level of support in the S&P 500 to hold. We anticipate that this gap that you see here gets closed. We anticipate that this level gets tested again. And if on that test it's successful, if we bounce to the upside, or if we get a 90% upside day or two back-to-back 80% upside days, that'll be enough for us to say we want to be in the market, and we would redeploy all the cash and capital we have sitting on the sidelines. So between now and then, if you have any questions at all, by all means, please give me a call. Send me an email. My direct line is 608-354-1977. My email, chris@careformywealth.com. I always look forward to hearing from you. There is no such thing as a silly question. I'm happy to help and guide you in any way that I can, and I'm thankful to continue to serve and work for you. By all means, let me know what's on your mind. Thanks again, and have a great night.